Coming down the home stretch here on a Tuesday, I'm Marlon Bowling with you, and I'm joined right now by Ted Seifried of Zaner Ag Hedge. He's located in Chicago. It's been one of those days here, Ted, where, we're waiting on the commodities to close out the trading month of August, close the books on it. A lot of folks would say a fond farewell to August. Get it out of here. It's been one of those months. It's been a challenging month. And it's not necessarily ending on a real positive note either. What does that mean?
Yeah, it really became a challenging month just recently, right? For the most part, we had been very sideways and, just kind of waiting for something to happen. Uh, and then things kind of happened. I mean, for one, we've got a better idea of what kind of crop we have out there. We've gotten some very timely rains. We're not really worried about a disaster of a crop, right? So that's taking some weather premium out of the market. But then, just in the last couple of days, all the destruction that has been caused down in the Gulf and the New Orleans area, there's a lot of port damage, right, and facility damage. And so that makes us really worried that we're going to have movement of grain. It's one thing to sell grain, but if we can't actually ship it, that's a problem. So from a basis perspective, from a flat price perspective, that has really weighed on the markets. But I'm going to argue that that was just a trigger. We've been looking like we wanted to roll over to the downside for a little while now. And fundamentally and seasonally, I've been saying for a few weeks now that we should go find these harvest lows. We should go find some more demand. While it's great to see China come in for 132, 133 thousand metric tons, like every other day, basically, it's not the big numbers that we really need to see at this time of year in order to hit the USDA's target. I think that those numbers are there. I just think they're maybe 60 to 80 to maybe $1 below where the market is right now. So the sooner we go and do that, the sooner we go and find that demand, the sooner we can turn around and have a post-harvest rally or a fall rally into the end of the calendar year, into the beginning of next year. I ultimately think that the balance sheet for the soybeans in particular, but also for corn, is going to be as tight, if not tighter, than what we saw this year. And we will have reason to get up to those upper prices. I just don't think we should have been price rationing demand before we get that demand. We have to have that demand come in first before we can say, okay, we're going to run out of soybeans again, like we did last year. And then we can really start talking about a rally. So this makes a lot of sense to me. The timing of it makes a lot of sense to me. I think there is still more downside potential from where we're at, although we do have support at 1280. It's all based on when China comes in and buys. And if they see this as a good level and they come in and buy 2 million metric tons, you can kind of say maybe we don't have to go down much more. But I have a sneaking suspicion that they're going to be patient. They're going to wait for a little bit better prices. But ultimately, I still do think that they're going to buy very aggressively.
Well, I have to give credit where credit is due. And I do have to admit, I believe you were the first commentator, first analyst I heard calling for an early harvest low this year, just out of necessity almost. I want to walk through these prices here, and we'll see if maybe they're working toward your goal that you were talking about, Ted. On the corn right now, 12.5 lower on that December contract. We're at 5.30 per bushel. With our quotes provided by bar chart here, you have November now trading 13 3/4 lower at 12.89.5. So it is coming off of its earlier low of the day here by a little bit. Now on Chicago wheat, let's switch over there. We have December now 3 lower at 7.20.5. That's off of our earlier low of the day by nearly 13 cents. In Kansas City wheat, you have December currently trading at 7.10.5. That's down only 2 cents right now. It's been on both sides of unchanged. And in Minneapolis, December wheat down 4 1/4, and it's now at 9.05.5 per bushel. That's a far cry from that low of the day, so it came off of that by about a dime as well. Ted, we'll come back in a moment and we'll talk about our livestock trade as we wrap up the month of August right after this. Well, as advertised, let's continue on here with Ted Seifried of Zaner Ag Hedge and see what he thinks about our livestock trade. All right, Ted, we've had a lot of pressure on the live cattle. We have October currently $1.35 lower. We're at 126.97 on the day, and that would be about $1.50 off of our earlier high. Now we're within about 15 cents of our low of the day. Feeder cattle market, we have the October contract $1.20 lower now at 167.75. That would be 65 cents from our low of the day. And from our earlier high, just about $2 off of that. So a big turnaround to the downside in feeders. And you have lean hogs actually trading lower as well. October down $1.42. We're now at 88.72 per hundredweight, and it's front loaded with the weakness here. The front months are showing the biggest losses, that's for sure. So bear spreading apparent going on there. Interesting how we have the feeders turning around to the downside today, Ted, with the big weakness being seen in the corn at the same time. What is that telling you?
Yeah, so frustrating is the answer there. You don't like that when you have corn down 12 to 15 cents and then the feeders reversing lower. That's not a good sign. Um, the whole livestock board is somewhat frustrating here today. You've got reason to think that cattle can go to the upside. We had the big breakout last Monday and then we failed and came back down, and it's been just floundering ever since. Now we're really just stuck in the sideways range once again. But with box beef prices being relatively strong, with packers margins being really very good, you can certainly justify higher cash prices. Now, whether we see them or not, I don't know. Fundamentals are there to go higher, and we're just not able to do that. So that has to be really frustrating. The feeder reversal lower is not great. I don't like cliches, but feeders are the leaders. Well, hey, this is not the direction we want to be led, I don't think.
Well, you never know. Maybe it means that at the end of the month, we'll cut everything off. Come in tomorrow, we'll have a new calendar month, and we'll start out with a clean slate. You never know. So anyway, we'll have to wait and see how it all shakes out after the close today. Ted, great to visit with you, and we'll talk with you again here real soon. Thanks for the help. Ted Seifried of Zaner Ag Hedge. Tammy, back to you.